Hey everyone, and welcome back to part 5 of our Retirement Masterclass series. Here in this episode, we're going to cover the IPS, known as the Investment Policy Statement, why it's important, why it matters, what it does for you, and how to create one. If you've missed any of the previous parts of this series, we actually have a link down in the description of this video where you can access the entire playlist and watch every video to make sure you're entirely caught up. Last time in part 4, we covered goals and how to use them to create your financial plans. We talked about why people typically fall short, how to set impactful goals, and why setting expectations for your situation is so important. So in this video, we're going to be diving into something that most investors tend to overlook, but the best ones never do. It's the Investment Policy Statement, or as we'll call it from here on out, the IPS. Now I know it sounds like it's just paperwork, but I promise it's not. It's power, it's clarity, and if you're serious about growing long-term wealth, especially with a trusted advisor, the IPS is where it all begins. You can really think of the IPS as your personal investment blueprint. It's a written document built with you. It's not built for you, it's built with you. It clearly lays out your goals, how much risk you're willing to take, how long you plan to invest, and any guardrails that matter to you, whether they're tax issues, legacy holdings, or social impact preferences. It's not about picking stocks or timing the market. It's about aligning your money with your purpose. And once it's written, it becomes the compass for every financial decision going forward, especially during times of market turbulence or uncertainty. If you've ever wondered what really anchors smart investors in times of uncertainty or when things start to feel like a storm, it's this document. Here's the truth. Without an IPS, your portfolio really has no true direction. It's reactive, non-strategic. You may have a decent return one year and then a bad one the next, and no real idea whether you're on track to meet your goals or not. With an IPS, we're building a strategy around you, not just your investments. But it's your life, your timeframes, your obligations, your values. When the market dips, the IPS doesn't panic. It reminds us why we're invested and the way we are going to keep the strategy disciplined. And then maybe more importantly, from the advisor side, it creates accountability. An advisor will not have to guess. They will simply be following a mandate, your mandate. When building a powerful IPS, we'll start with the background. Start with who you are, your age, your family structure, your tax profile, your assets, whether it be real estate, business equity, portfolios, etc. We want the full picture. Not just the accounts that get managed, but including anything significant. Even if it's outside the investment portfolio, this also includes your values, since those also can influence investment decisions. Step 2 is identifying the investment objectives. What are we solving for? Retirement? A second home? Generational wealth? Giving back through philanthropy? Most clients have multiple goals, and sometimes they even conflict. The IPS helps prioritize. For example, if you want to retire comfortably, buy a second home, and give to charity, the IPS helps us order those goals and build a strategy to make sure that you can achieve them all. Next is setting the investment parameters. This is where it gets personal. How much risk can you handle? Not just on paper, but emotionally. What's your time horizon? 5 years, 15 years, etc. What asset classes are you comfortable with? Do you want to avoid private equity or only invest in ESG-friendly funds? We document it all, because these choices shape your portfolio and how you're going to invest. After doing all that, we need to identify the constraints. Let's say you have a large stock position with big unrealized gains. Or you don't want to sell inherited shares from a family business. Or maybe you have a religious or ethical guideline on where your money should not go. That's not a problem. It just needs to be named and planned around. Now we actually get into how we're investing with the asset allocation strategy. Strategic asset allocation is long-term and stable. Tactical allocation allows some shorter-term shifts. You might choose one or a blend of both. The IPS will set target allocations and flexibility ranges to guide how your money gets deployed. Markets can shift, and that's why portfolio management and rebalancing is a part of your IPS. Your IPS tells us how often we should check and adjust. Should we rebalance quarterly, or when allocations drift past a 5% limit? Should we have a full discretion to act or confirm everything with you first? These rules get set up in advance. This removes any emotion and helps us attack the moment when it's right. The roles and responsibilities part of an IPS outlines what your advisor is responsible for. From drafting the IPS to choosing funds, monitoring allocations, reporting performance, taxes, proxy votes, all of it. It may also include any third-party managers or custodians that will be involved with your portfolio. Finally, we'll have the appendix. The appendix is where we can run simulations, wondering what your likely range of outcomes over the next 10, 15, 20 years looks like. Maybe you're wondering your downside risk in a recession year. We can model all of this, not to predict, but to prepare so we can act if these situations arise. So to put all this in an example, we have a case study for you. Meet David and Amelia. They're in their mid-60s with over $12 million in investable assets. They need about $350,000 annually to support their lifestyle and want to buy a second home in the next 2 years. They're comfortable with some volatility, but they do want clarity. Their IPS helps us know exactly how much risk to take, what cash to keep aside, and what their estate plan will support over time. They also have legacy holdings, shares from an old employer, and a private real estate interest. Thanks to the IPS, we didn't need to liquidate those. We built around all of it. That's the magic of having an IPS. It doesn't force a model onto your life. It molds your strategy around your life. So to sum it all up, we'd like to leave you with this. If you don't have an IPS, you're investing blindfolded. And if your advisor hasn't built one with you, they're managing your money without a map. Here at Confluent, we treat the IPS not as a checkbox, but as a living strategy document. It evolves with your life, it reflects your goals, and it builds accountability into every move made with your capital. So if you've been navigating this journey to financial freedom without that map, now is probably the time to build it. So that will bring us to the end of episode 5 here in our Retirement Masterclass series. So far, we've covered time horizons, risk tolerances, account types, setting goals, and now the IPS. Coming up next in part 6 of the series, we're going to cover asset classes and the pillars of wealth. So stay tuned and continue this journey to putting yourself ahead of the rest of the crowd when it comes to retirement planning. We hope you enjoyed this video on the investment policy statement and how it is so important to your financial plans and your retirement plans. This is actually part of a bigger Retirement Masterclass series where we cover retirement from front to back. So please, if you did enjoy the video, go ahead and drop a like, subscribe to our channel, hit that notification bell so you can stay updated and get every new video from us as a part of this masterclass and all the other great content we have helping you achieve your financial goals.